Okay, let's dive in. You've handed us this stack of sources that give us this incredible, really detailed look at U.S. monetary history,
Yeah,
specifically drawing on well, pretty significant work covering the years 1867 right up to 1960.
that's right. And it's a crucial period, really transformative for the U.S. economy.
Mhm.
You've got, dramatic changes, financial panics, major wars, and the whole birth and early evolution of the Federal Reserve System.
And what's cool about these sources, I think, is their focus. They really zoom right in on the money stock itself.
Yeah, the actual amount of money circulating.
Right. And its key drivers. We're talking things like high-powered money, the deposit reserve ratio,
Extra currency ratio.
basically the plumbing of the monetary system. Rather.
Exactly.
Right.
And how these factors, which often get overlooked, influenced, well, everything, economic stability, prices, income throughout this whole era.
So our mission today is to sort of guide you through this material, pull out the absolute must-know insights.
Yeah, help you grasp how these historical forces really shape the financial world we live in now. Think of it as your deep dive shortcut.
All right, let's unpack this then, starting right after the Civil War.
Yeah.
The sources plunge us into what they call the Greenback period,
Yep.
1867 to 1879.
Mm-hmm.
And the monetary setup here is just, it's fascinatingly weird compared to what we know today.
It really was unique. They describe it as a fiduciary standard. So forget a fixed commitment to gold.
Right.
The U.S. government wasn't promising to sell gold at some set price. Instead, U.S. currency, the greenbacks, they had freely floating exchange rates against other currencies, like the British pound sterling.
Which was linked to gold.
Which is linked to gold, exactly. So you had greenbacks and gold circulating side by side domestically, but their value relative to each other was, constantly shifting.
Wow.
It's a setup we hadn't seen for decades and really haven't seen since. Not quite like that.
So back in 1867, what actually made up the money supply? What counted as money?
Well, primarily it was physical currency. You had the greenbacks themselves, national banknotes, which were issued by commercial banks,
Okay.
and subsidiary coinage, small change. Commercial bank deposits were also money, of course.
Sure.
But the sources point out that the formal distinction we make today between demand deposits, like checking accounts, and time deposits, like savings, it wasn't as meaningful back then.
Ah, interesting. Why not?
Well, that really changed later with the Federal Reserve Act in 1914. That's when they introduced different reserve requirements based on the type of deposit. Before that, the lines were a bit blurrier in practice.
Okay. And a key part of this Greenback story leading up to the U.S. going back on gold, that was the price of gold itself, wasn't it?
Absolutely crucial. The sources really highlight this sharp decline in the price of gold,
Right.
and therefore sterling from its peak during the Civil War around 1864.
Right, it had soared.
Oh, yeah. It went over $2.50 in greenbacks for what used to be a gold dollar pre-war, but then it fell steadily all the way back down to parity.
1 for 1.
1 for 1. By the time the U.S. resumed gold convertibility in 1879, and this price decline, it wasn't just incidental. The sources stress it was a necessary condition.
It had to happen.
It had to happen for a successful resumption at that pre-war parity. The greenback had to appreciate against gold.
Got it.
Yeah.
Now, the period from 1873 through 1878, that's often marked as an economic contraction.
Yes, and it's interesting, looking back now with certain, physical production data, it might seem maybe shorter or less severe than some others.
Right.
But the people living through it, they felt it very differently. The sources note that contemporaries saw this downturn marked by falling prices. A lot of monetary uncertainty. They saw it as the onset of the Great Depression of their time.
Wow. And why were prices falling and conditions so depressed? What did people think then?
Well, contemporary discussion and the sources basically agree that they largely attributed it to the behavior of the money stock. Given how rapidly the U.S. economy was actually growing in real terms, physical output, a faster growth in the money stock was really needed just to keep prices stable.
Ah, so the money supply just wasn't keeping up.
Exactly. It wasn't keeping pace with the economy's underlying potential, leading to that downward pressure on prices.
Okay, so let's get into the plumbing then. What was actually driving the changes in the money stock during this Greenback period?
The sources identify sort of two main phases with different drivers. First, there was a sharp rise in the money stock from about 1868 to 1872.
Okay.
And the primary driver here, the spread of deposit banking.
Meaning?
Meaning people were just getting more comfortable using banks, holding bank deposits relative to physical currency. And critically, banks themselves were getting more efficient. They were essentially creating more deposits for every dollar of vault cash they held. That deposit reserve ratio was rising.
So just people's banking habits changing actually boosted the money supply. That's a powerful insight.
It is, exactly. Changes in public trust and just banking practices can have this huge multiplying effect on the money supply, even without, direct government action changing the base money.
But then it reversed.
But then, yeah, there was a decline in the money stock from 1877 to 1879. And this decline, the sources show, was largely due to a series of failures among non-national banks.
Ah, bank runs and failures?
Right. And these failures had the opposite effect. They scared people, scared banks. It caused those key ratios, the deposit currency ratio and the deposit reserve ratio, to move in reverse. People wanted more currency. Banks wanted more reserve.
Shrinking the multiplier.
Shrinking the money multiplier, exactly.
And the monetary authorities, the government, Treasury, they weren't completely passive during all this, were they?
No. The sources note that changes in high-powered money, that's the monetary base controlled more directly by the government and Treasury, those changes also contributed to both the rise and then the subsequent decline in the overall money stock. It wasn't just the ratios.
Okay, that brings us out of the Greenback era then, and into this period from 1879 to 1914. The sources label this silver politics and the gold standard.
Right.
And this is where we hit that controversial crime of 1873.
Yes, the demonetization of the standard silver dollar in 1873. Now, initially, it was seen almost as a non-event.
Really? Why?
Because it was basically just putting into law what was already happening. The silver dollar hadn't really circulated since about 1836 because silver's market price was higher than the price the mint paid for it.
Oh, okay.
So people just weren't bringing silver to the mint to be coined into dollars. They could get more for it selling it on the open market. The 1873 Act just recognized that reality.
That situation didn't last.
It did not. Starting around 1872, just before the act, there was this sharp, long-term decline in the price of silver worldwide.
What caused that?
Two main things, according to the sources. One, huge new silver mines were opening up in the U.S. West, massively increasing supply. And two, crucially, several big European countries started shifting away from silver or bimetallic standards towards gold. That reduced global demand for silver significantly.
And that big drop in silver prices created a major problem for those U.S. silver producers.
Absolutely. After 1875 or so, they suddenly couldn't profitably sell their silver on the market for more than the old mint price anymore.
Hey.
They were stuck with silver that was now worth less than the mint price would have been, but the mint was no longer obligated to buy it for coinage because of that 1873 act.
So they were furious.
They were furious. They branded the act a crime, alleged this whole conspiracy against silver. Now, historians generally don't find evidence of some grand conspiracy back when the act was passed, but the provisions certainly did end up solidifying the U.S. commitment to a gold basis, especially as silver's price kept falling later. It became politically explosive.
Yeah, I can imagine. The sources also dig into the role of Treasury cash between 1879 and 1897. What's the point there?
This is a subtle but pretty interesting point. The Treasury's cash balances, how much money the government had on hand, fluctuated quite a bit based on tax receipts, government spending, things like that.
Sure.
And these fluctuations often ended up being the main driver of the shorter-term movements in high-powered money.
Okay.
So the sources suggest that because these were short-term swings driven by government finances, not necessarily the needs of the economy or international trade, they might have actually introduced unnecessary instability.
How so?
Well, they could cause high-powered money to contract, say, when maybe international trade conditions called for it to expand or vice versa. It could sort of mess with the signals and potentially trigger unnecessary gold flows in and out of the country.
Huh. Interesting. Now, the period from 1891 to 1897 is highlighted as pretty troubled economically. Money stock declining. What was going on?
Yeah, that was a challenging stretch. There were several contractions. And the sources link this economic trouble, partly at least, to uncertainty about the monetary standard itself.
The silver pressure again.
Exactly. Concerns about whether the U.S. could or would maintain gold convertibility, especially with all the political pressure from silver interests.
And that uncertainty had real effects.
Oh, yeah. It led to capital outflows. Essentially, foreign investors, or even wealthy Americans, started moving their money out of the U.S.
A forced export of capital, they call it.
Right. Because they were worried about the value of their dollar assets if the U.S. suddenly went off the gold standard or embraced silver monetization.
So how did they manage to stabilize things? That sounds precarious.
Well, there was the famous 1895 syndicate deal where J.P. Morgan and others basically formed a private group to help the Treasury get gold and defend its reserves.
Right.
That was a dramatic signal of confidence, and it helped stop the capital flight, at least temporarily. Then later, the Republican victory in the 1896 election reduced the immediate political pressure for silver. And kind of conveniently, world gold supplies started increasing around then, too, which also eased the strain on the dollar's gold backing. Though the sources note that solid business improvement didn't really kick in until mid-1897.
Okay, that takes us up to 1897 to 1914. And this period is characterized very differently. Gold inflation and the road to the Fed. Sounds like a change of tune.
It absolutely was. This was generally a period of strong economic expansion, and the sources label it gold inflation.
Why gold inflation?
Well, two major global factors were at play. One, there was a rapid expansion of world gold production, new discoveries in South Africa, Alaska, new technologies like the cyanide process making extraction cheaper.
Right.
So gold itself became relatively cheaper compared to other goods worldwide. That tends to push prices up globally under a gold standard.
And the second factor?
The growing industrial strength of the U.S. economy itself. It was offering increasingly attractive investment opportunities, drawing in capital.
Okay, so how did those monetary ratios, the plumbing, behave during this big expansionary period?
Well, the deposit currency ratio, that continued its steady upward trend, pretty similar to the previous period.
People using banks more as incomes rose.
Exactly. The sources suggest it reflects rising real incomes, people getting wealthier and using banks more, plus just the growing convenience of banking services.
But the other ratio?
But the deposit reserve ratio? That one rose more rapidly during this time, especially between about 1897 and 1907.
Meaning banks held fewer reserves relative to their deposits.
Correct. Banks were holding less cash in the vault for every dollar of deposits they owed.
Why would they do that, especially after the troubles of the 1890s?
The sources point to rising interest rates as a likely cause. When market rates for lending money are high, holding on to idle cash reserves above the legal minimum becomes more costly, in terms of lost potential earnings.
Opportunity costs.
Right. So banks had more incentive to cut back on those extra prudential reserves and lend more out.
So banks were running leaner on reserves, maybe chasing profits a bit more aggressively.
That seems to be part of the story, yeah. And this likely contributed to periods of money market stringency, times when credit suddenly got tight.
Right.
The sources even mentioned Treasury Secretary Shaw taking some pretty notable actions back in 1902, trying to ease things. He injected funds into the market by buying bonds and shifting government deposits into national banks, quite interventionist for the time, added something like $57 million.
Trying to relieve that tightness. Which I guess brings us to the really dramatic event that finally pushed things towards major reform.
Yeah.
The Panic of 1907.
Yeah, that was a severe financial crisis, really intense money market stringency, stock market collapse. The sources highlight J.P. Morgan again, organizing those famous money pools, private efforts, basically to inject liquidity and try to shore up confidence.
Right.
Savings banks had to demand advance notice for withdrawals, and critically, you saw a breakdown in the basic payment system. Well, the use of emergency currency substitutes like loan certificates and clearinghouse certificates because actual currency was so scarce. And a major dislocation of domestic exchange, making it really difficult and costly to move money between different parts of the country. Checks drawn on one city might trade at a discount in another.
Wow. Messy. And what was the key takeaway from 1907 about the monetary system itself?
The sources really emphasize that the panic starkly demonstrated the banking system's vulnerability, especially with those higher deposit ratios we just talked about.
Right, the leaner reserves.
Exactly. It made it much harder for banks to handle a sudden surge in depositors wanting to convert their deposits into physical currency. There just wasn't enough cash readily available in the system relative to the deposit liabilities.
So 1907 really drove home the need for something else.
Undeniably. It underscored the urgent need for systemic reform, specifically for some kind of central authority that could act as a lender of last resort, provide liquidity during a crisis, prevent the whole system from seizing up like that.
And that need led directly, of course, to the establishment of the Federal Reserve System in 1914. Now, what were the expectations for this new institution? What did its founders think it would do?
Well, the founders, operating under the ideas and, frankly, the conditions of their time, made two really key assumptions, according to these sources.
Okay.
First, they assumed the world would continue to operate under a relatively stable worldwide gold standard, like it had, more or less, for decades. And second, they believed the Fed would primarily lend based on something called the real bills criterion.
Real bills. What's that?
The idea was that the Fed should lend mostly against short-term commercial loans that were made for actual tangible business transactions financing goods in production or transit. The thinking was this would automatically supply the right amount of money and credit needed by the real economy, expanding and contracting naturally with business activity.
Okay, so those are the assumptions. How did they hold up?
Well, the sources note, pretty bluntly, that both of these assumptions proved inadequate almost immediately. Yeah. The gold standard basically blew up with World War I, and the idea of lending only against real bills, that went out the window pretty quickly too, especially once the U.S. entered the war and government debt became a major form of collateral for Fed lending. The realities just overtook the initial design very fast.
Speaking of World War I, how did that massive event impact the money supply now under this brand new Fed system?
Well, during the period when the U.S. was still neutral, from 1914 to 1917, the sources show money stock growth was entirely driven by a huge inflow of gold.
Why was gold flowing in?
European powers, mostly Britain and France, were financing their war efforts by buying enormous amounts of U.S. goods, and they paid for a lot of it by shipping gold to the U.S.
Well,
This actually dramatically shifted the U.S. international position. It went from being a net debtor nation to a net creditor nation in just a few years.
wow. And after the U.S. entered the war in 1917,
Then the financing shifted. It became primarily about U.S. government borrowing to fund its own war effort. And the sources describe the Fed during this period effectively becoming the bond-selling window for the Treasury. Meaning it used its powers, setting discount rates, buying bonds almost entirely to keep interest rates low and make it easy for the government to sell massive amounts of war bonds to the public and banks. Monetary policy basically took a backseat to war finance.
Okay. What happened right after the war ended in 1918? Things go back to normal.
Not quite. The wartime gold embargo was lifted in 1919, and gold started flowing back out of the U.S. The Fed's reserve ratio, its gold holdings relative to its liabilities, fell pretty sharply. This caused concern. Benjamin Strong, who was the very influential governor of the New York Fed back then, argued strongly for raising discount rates to curb what he saw as excessive credit expansion and speculation bubbling up post-war.
And did they?
Yes, despite some opposition within the system, rates were indeed raised significantly in late 1919 and again in early 1920.
And this is followed pretty quickly by the contraction of 1920-21.
Yes, exactly. The sources show a really significant decline in high-powered money during this contraction, a 17% drop. That's actually one of the largest percentage declines in the entire 1867-1960 series they studied.
Wow. So the Fed tightened and the base money shrank dramatically.
It did. The overall money stock fell about 9%. And it's interesting, the sources note that a rise in the deposit currency ratio during this time, people shifting towards deposits relative to currency, actually cushioned the impact slightly.
Yeah.
Without that shift in public preference, the money stock fall would have been even larger given how much high-powered money dropped.
Okay. The sources then describe the next period from 1921 up to 1929 as the high tide of the reserve system.
Yeah.
Sounds positive.
Yeah, in many ways it was. It was a period of rapid economic growth, technological change, the Roaring '20s, without any major deep recessions like the ones before or, tragically, the one to come. It seemed like a new era of stability.
But there's always a but, isn't there? There's that striking detail about bank failures.
Right. That's the discordant note. Despite the apparent prosperity and lack of big contractions, there was this strikingly high rate of bank failures throughout the 1920s, mostly smaller rural banks.
Wow.
It was like this persistent underlying weakness in parts of the banking system, even during the good times. Perhaps, a hint of the vulnerabilities that would be exposed later.
So how did the Fed generally approach monetary policy during this decade, this high tide? What were they focused on?
The sources are quite clear, and this is a really crucial point for understanding what happened later. The Fed's attention, its operational focus, was almost exclusively on the credit aspects of its operations.
Meaning interest rates.
Meaning interest rates, yes, but also just the general availability of credit in the market, the feel of the money market, the cost of borrowing for banks and businesses.
Oh.
They saw their job as managing credit conditions.
Okay. What weren't they focused on?
They weren't systematically looking at or trying to control the behavior of the money stock itself, the overall quantity of money.
That seems like a big omission for a central bank.
Looking back, yes. But that was the prevailing view then. Gold inflow during the period was largely sterilized, too.
Sterilized.
Meaning the Treasury or the Fed took offsetting actions, like selling government bonds, to prevent incoming gold from automatically increasing the reserves in the banking system and thus expanding the money supply. They were trying to manage credit, not the money quantity per se.
Which brings us to the end of the decade, the stock market boom of 1928-29, and the debates within the Fed about how to respond.
Absolutely. This was a major point of contention. Benjamin Strong, before his untimely death in 1928, had been pushing hard for stronger action, specifically higher discount rates, to try and rein in what he saw as dangerous speculative excess in the stock market.
But he faced opposition.
Significant opposition from others within the Federal Reserve System. Some leaders, particularly from interior banks, were perhaps more influenced by that old real bills idea. And they preferred banks to just borrow from the Fed if they needed funds for legitimate business, rather than the Fed actively tightening conditions or putting reserves into the market through open market operations. There was this fundamental debate. Should the Fed use direct pressure on banks lending for speculation or moral suasion, or should it just use its broad tools like the discount rate? George Harrison, who took over at the New York Fed after Strong, was trying to navigate these internal tensions, pushing for a board approval for rate increases in 29 amidst all this disagreement.
And all this is the structure of the Fed, its policy focus on credit, not money, these internal debates. It really sets the stage for what the sources call, ominously, the Great Contraction from 1929 to 1933.
It really does.
The scale here, as described in the sources, is just unprecedented.
It's truly horrifying. The money stock fell by over a third. Just let that sink in. More than a third of the nation's money supply vanished in about 4 years.
That's staggering.
It's more than 3 times larger than any previous decline they measured in that whole 1867-1960 series. And the banking system, over a fifth of all commercial banks in the U.S. failed or suspended operations.
What fifth?
The total number of banks dropped by over a third between 29 and 33. It all culminated, of course, in the nationwide banking holiday declared by Roosevelt right after his inauguration in March 1933.
The sources also note something interesting about the money stock before the downturn actually started in August 1929.
Yes, that's a key point. Unlike most previous contractions where the money stock had generally been rising, sometimes quite rapidly, right before the peak. In the period leading up to the August 1929 business cycle peak, the money stock had actually failed to rise. It was stagnant.
A warning sign, perhaps.
In retrospect, perhaps. Now, the stock market crash in October 1929, that was the big dramatic event everyone remembers. But the sources make a really important distinction here. The crash was the climactic event in the stock market, but it wasn't the direct trigger for the monetary collapse. The really accelerated downward spiral of the money stock didn't begin until much later, in the last couple of months of 1930.
What happened then?
That's when the first major wave of bank failures hit, starting in the agricultural regions and then spreading. And the sources emphasize this was predominantly a domestic crisis.
Not imported from abroad.
Not primarily, no. It was driven by the sequence of bank failures within the U.S. banking system. In fact, the U.S. gold stock actually rose significantly during the first 2 years of the contraction.
Really? So gold was flowing in?
Yes, which suggests that other countries were actually feeling the effects of U.S. deflation, not the other way around, at least initially. The problem originated at home.
Okay, so if it wasn't mainly transmitted from abroad, and it wasn't just the stock market crash, what were the primary drivers of that catastrophic money stock decline? How did it happen?
Well, according to the sources, it started with an initial, actually relatively small decline in high-powered money from the Fed. But, and this is the crucial part, this initial effect was massively multiplied by sharp declines in those 2 key ratios we keep coming back to.
The deposit ratio.
Exactly. First, the deposit currency ratio just plummeted. The public, terrified by bank failures, lost confidence and started pulling their deposits out to hoard physical currency. They wanted cash in hand, not deposits.
A classic bank run psychology.
On a massive scale. And second, the deposit-reserve ratio also fell sharply. The banks that survived, facing runs and immense uncertainty, frantically tried to build up their liquidity. They started holding huge amounts of reserves, far more than legally required, because they were scared.
So people pulled cash out, and the banks that were left held on to the remaining cash even tighter.
Precisely. And because both of those ratios act as multipliers on high-powered money, even a modest initial drop in the base money, when combined with those huge, fear-driven shifts in public and bank behavior, led to that catastrophic collapse in the overall money stock. And the sources also make the point that the banking system was actually even more vulnerable at the start of the crisis in 1929 than it had been back in 1907.
Why is that?
Because those ratios were higher to begin with. Banks generally had higher deposit-to-reserve ratios, and the public was holding more of its money in the form of deposits relative to currency compared to 1907. So when the crisis hit, the potential fall was even greater.
Now, there's debate, the sources mention, about the ultimate origins of all those bank failures. Was it bad practices in the 20s or just the unfolding depression itself?
Right, that's a complex historical debate.
But the sources highlight what they see as the most important effect of the failures, regardless of the cause.
Yes. While the causes of individual failures are certainly important and debated, the sources are crystal clear on this. The single most important consequence of that wave of bank failures was their indirect monetary effect.
Through the ratios.
Exactly. By terrifying the public into hoarding currency and terrifying the surviving banks into hoarding reserves, the bank failures themselves became the primary engine driving the collapse of the money supply. That was their biggest impact on the Depression's depth.
Okay, so where was the Federal Reserve in all this? What was his role?
Well, the sources offer a pretty stark critique here. They describe the Fed's response throughout this critical period as largely passive, defensive, and hesitant.
Passive. But wasn't it created exactly for this kind of crisis?
That's the tragic irony.
Right.
The system, despite being designed in part to prevent such panics by acting as a lender of last resort, largely failed to meet that internal drain, the public's flight from deposits into currency, in the way its founders had envisioned. Despite the economy suffering the worst contraction in its history, the sources show the Fed actually allowed its own credit outstanding, its loans and security holdings, which directly impact high-powered money, to decline significantly through much of the period, especially into early 1932. They weren't aggressively injecting reserves.
Why not? Were there internal disagreements again, like in the late 20s?
Absolutely. The sources detail these continuing internal debates. Governor Harrison, back at the New York Fed, he was generally pushing for more aggressive, expansionary action, particularly using open market operations, buying government securities to pump reserves into the system.
But others disagreed.
Strongly. Others, like James McDougall at the Chicago Fed, remained very opposed to the Fed actively putting reserves into the market this way. They still worried it would just fuel speculation or enable banks to avoid borrowing directly from the Fed's discount window, which they saw as the more appropriate channel. McDougall, for instance, consistently advocated for selling securities, not buying them, during parts of the contraction.
Selling securities during the Great Depression.
Wow.
Yeah.
It reflects that deep division in thinking about how the Fed should operate.
The sources actually pinpoint a specific missed opportunity early on, don't they? A counterfactual.
They do. They make a very powerful quantitative point. They calculate that if the Fed had undertaken a vigorous expansion of high-powered money early on, say, buying about $1 billion worth of government securities in just the first 10 months of 1930.
Which they had the power to do.
Oh, easily within their power. Instead, they only increased their holdings by about $150 million in that period.
Okay.
The sources argue that this much larger $1 billion injection could have drastically changed the monetary situation. They suggest it would very likely have been enough to offset the decline in the ratios and actually convert the money stock's sharp decline into a modest rise.
Potentially altering the course of the Depression itself.
That's the implication, a huge potential turning point missed.
And the intellectual climate at the time, the prevailing economic ideas, contributed to this lack of forceful action.
Yes, the sources argue that played a significant role. The prevailing focus, both within the Fed and among many economists outside, was still primarily on those credit conditions, interest rates, the availability of loans, rather than on the sheer quantity of the money stock itself.
So they weren't looking at the collapsing money supply as the main problem.
Not systematically, no. And this focus, the sources argue, contributed both to the Fed's passive stance and also to a lack of really forceful, effective outside criticism demanding different action. The argument essentially is the system failed to use the powers it did possess, partly because its framework for thinking about the problem was flawed.
Okay. Moving forward out of the depths, the sources cover monetary policy and recovery from 1933 to 1941. How did the banking system even start to recover after that devastation?
Well, the restoration of the banking system after the 1933 holiday was obviously a massive undertaking. Part of it, the sources note, was significantly aided by the Reconstruction Finance Corporation, the RFC.
How did the RFC help?
After 1933, the RFC actually invested over $1 billion directly into bank capital, buying preferred stock in banks. This helped recapitalize almost half the banks that were allowed to reopen after the banking holiday, shoring up the system's foundations.
And then the New Deal brought a whole raft of really significant monetary policy changes, didn't it?
Oh yeah, a whole series of fundamental shifts. The sources highlight several key ones.
Right.
Okay, so you had the prohibition of interest payments on demand deposits, part of the Banking Act of 1933. You had the nationalization of gold, an executive order forbidding private hoarding domestically.
Right.
The abrogation of gold clauses in contracts, which said debts had to be repaid in gold of a certain weight. That was nullified.
Big deal for debtors.
Huge. And then, of course, the devaluation of the gold dollar in 1934 and the return to a modified gold standard at $35 an ounce.
Modified how?
Well, under this new system, the mint would buy all gold offered to it at $35 an ounce, but it would only sell gold for settling international payments. Private citizens couldn't own monetary gold domestically anymore.
Okay. And there was also a silver purchase program.
Yes, the Treasury undertook a program to buy silver, issuing silver certificates against it.
Huh.
This also added to high-powered money and the overall money stock, partially offsetting the huge expansionary effect that was coming from gold inflows.
Right. And the economy did see a pretty vigorous rebound from 33 to 37.
It did. The sources document really extraordinary rates of growth in net national product during those years. The money stock also grew very significantly.
What was driving the money growth then? Still gold.
Predominantly, yes. It was driven mainly by that continued massive gold inflow, partly as capital fled growing instability in Europe, but also, interestingly, by a major decline in the deposit reserve ratio.
Wait, banks held fewer reserves again after the trauma of the early 30s?
Fewer reserves relative to the massive inflow of reserves they were getting from the gold. What was happening was banks were accumulating enormous amounts of excess reserves held above a legal requirement.
Oh, okay.
They were building up this huge liquidity cushion rather than lending out every dollar that came in. So while total reserves soared, the ratio of deposits to those reserves fell, meaning banks weren't fully leveraging the new reserves into loans and deposits. Velocity also fell during this period, by the way.
Okay, so lots of gold coming in, banks sitting on huge excess reserves. How did the Federal Reserve approach policy during this period, say from 34 to 41?
The sources characterized the Fed's policy during these years as, again, largely passive in terms of its traditional tools.
Passive again?
Yeah. Discount rates were kept very low and often left unchanged for years at a time. Open market operations were minimal, or security holdings were kept at fixed levels for long stretches.
So what do? They had this new power over reserve requirements, right?
Exactly. That became the main tool they actually used, and they used it drastically, doubling the required reserve ratios in 3 steps between August 1936 and May 1937.
Doubling them. Why?
Well, the sources argue this wasn't primarily aimed at affecting current economic conditions, which were still recovering. It was more about trying to get control over that enormous overhang of excess reserves in the banking system.
Wow.
The Fed was worried that these excess reserves represented a huge potential for future monetary expansion and inflation that they wouldn't be able to control later. So they raised requirements to essentially lock up a large chunk of those excess reserves.
Still focused on potential future problems rather than current conditions.
And still preoccupied, the sources say, with the credit effects, with very little systematic discussion within the Fed about the quantity of money itself.
And this policy of doubling reserve requirements,
Yeah.
it had consequences, didn't it? Especially leading into the sharp recession of 1937-38.
It absolutely did. The sources conclude pretty strongly that a sharp slowdown in money growth and then an absolute decline in the money stock actually the third largest cyclical decline recorded in their whole series, was directly produced by these deliberate policy measures.
How?
Well, the doubling of reserve requirements, combined with the Treasury deciding around the same time to start sterilizing incoming gold, meaning it stopped letting gold inflows increase bank reserves, directly offset the expansionary pressure from the gold inflow that had been driving recovery.
So policy actively caused a monetary contraction.
That's the argument. And the sources maintain that this monetary contraction surely contributed significantly to initiating and intensifying the sharp economic downturn that began in mid-1937, another major policy error in their view.
Okay, that brings us then to World War II and the post-war era, the final stretch from 1939 to 1960 in this study. The sources describe the war years leading into about 1948 as a period of World War II inflation.
Yes, a very significant and protracted inflation. The money stock nearly tripled between 1939 and 1948. Wholesale prices more than doubled over that period.
Wow. And velocity, did it behave normally during the war?
No, velocity behaved quite unusually again. It initially rose slightly at the very start, but then it fell sharply during the war years themselves, before starting to rise again post-war.
What was fueling that massive money stock growth during the war? Was it still gold?
The sources show a clear shift. During the initial neutrality period from 39 to 41, yes, it was still largely gold inflow driving the increase in high-powered money.
But during the war itself?
During the war itself, after Pearl Harbor, the source shifted almost entirely to Federal Reserve credit outstanding.
The Fed buying bonds again.
Exactly. The Fed essentially reverted to its World War I role, becoming the Treasury's bond-selling window again. It used its monetary powers almost exclusively to support government financing.
How?
By pegging interest rates on government bonds at very low levels. This made it easy and cheap for the Treasury to sell the enormous volume of bonds needed to finance the war, but it meant the Fed had to create whatever amount of high-powered money was necessary to maintain those pegs. Money supply became secondary to financing the war.
Price controls were used extensively during the war, from 42 to 46. How did the sources view their effect on measuring inflation?
They note that while the official price indexes showed slower rises during the control period, the controls often concede the true extent of inflation.
How do you conceal inflation?
Through things like hidden quality deterioration, same price, worse product, or the elimination of discounts and special offers, or just widespread shortages that force consumers to buy less desirable, maybe more expensive substitutes, or simply wait. All of these are effectively price increases that aren't always captured well by the official indexes.
Got it. And that sharp decline in velocity during the war while the money supply was exploding. That's a notable point, isn't it? Usually velocity rises in expansions.
It is very notable. Normally, as you say, velocity falls in contractions and rises in expansions. This sharp drop during a major wartime expansion is unusual.
Why did it happen?
The sources suggest several contributing factors. One, just the sheer unavailability of many consumer gears to buy. People had rising incomes but fewer things to spend on, so they tended to save and accumulate liquid assets like cash and bank deposits.
Makes sense.
Also, perhaps expectations of a post-war price decline or even another depression might have made holding on to money seem prudent. And maybe increased mobility due to the war effort, people moving around for military service or war jobs made holding higher cash balances desirable for transactions.
So people expected to spend it later.
Yeah, an immediate post-war spending spree and a sharp rise in velocity was widely expected. But the sources note that while velocity did rise after the war, it actually took longer to materialize than many had anticipated.
Okay, fast forward a bit into the post-war era. The sources pinpoint a really significant policy shift in the early 1950s.
That's right. The Treasury-Federal Reserve Accord of March 1951.
The Accord? What was that?
It was a critical agreement that formally ended the Fed's wartime obligation to support government security prices at those pegged low levels.
So it freed the Fed from the Treasury.
In essence, yes. It allowed interest rates to become much more flexible, to be determined more by market forces and the Fed's own policy objectives, rather than being dictated by the Treasury's financing needs.
And the sources call this a near-revolutionary change for the Fed. Why so dramatic?
It was revolutionary primarily in how the Fed thought about and conducted monetary policy. Post-Accord, the sources argue, the Fed began explicitly considering the behavior of the money stock itself as a relevant guide and criterion for its policy decisions.
Alongside credit conditions.
Yes, alongside the traditional focus on credit conditions and interest rates, but adding the money stock as an explicit target or indicator was a massive shift from their earlier focus, which was almost purely on credit availability and cost.
So the ideas that were maybe dismissed in the 30s started gaining traction.
Exactly. The concept of aiming for appropriate long-term growth in the money supply and also making counter-cyclical adjustments to it, leaning against the wind of the business cycle by actively managing money growth that really gained traction and became a much more central part of monetary policy thinking within the Fed after the Accord.
Okay, let's try and tie this epic journey through nearly a century of monetary history together then. Drawing on some concluding thoughts from these sources, what are the most important consistent relationships they found over this long period?
Well, the sources consistently find that the closest and most reliable relationships are between movements in the money stock, both the long-term secular trends and the shorter-term cyclical swings and corresponding movements in nominal income, things like GDP measured in dollars and the overall price level.
Money drives nominal variables.
That's the strong conclusion. They also see a very close link between the cyclical ups and downs in the money stock and the cyclical variations in real income and general business activity. Money changes seem to lead business cycle turns.
But the link isn't as strong for long-term real growth.
Correct. The sources explicitly note that the relationship between the long-term growth rate of the money stock and the long-term growth rate of real output, real income, is much less close.
So what determines long-run growth?
Well, it suggests that over the long haul, other factors, technology, capital accumulation, population growth, institutions, are the primary drivers of how fast the economy grows in real terms. Unless, and this is a key qualification, unless monetary instability itself becomes really marked. When the money supply is highly unstable, like during the Great Contraction, that instability often spills over and actively hinders stable real economic growth. So stable money might be necessary, but not sufficient for long-run growth.
Okay. And what about velocity over this whole long period? Did it change much?
Velocity, how quickly money turns over in the economy, actually showed pretty steady, gradual changes over the very long run, mostly trending downwards over this specific period. Except for those two major disruptions. The dramatic decline and subsequent rebound during the Great Contraction in the 1930s, and then again that sharp fall and slower recovery around World War II. Those were big deviations.
Well, it's cyclically. Within the business cycle.
Cyclically, velocity is actually quite stable and predictable. It tends to rise during economic expansions and fall during contractions. Even the huge movement during the Great Contraction fits that pattern. The sources argue velocity fell so much primarily because the economic contraction itself was so unprecedentedly large.
Right. Finally, the sources offer this really thought-provoking counterfactual about the Great Contraction, comparing it to the pre-Fed era.
Yeah, they pose this fascinating question. If the pre-1914 banking system, the one without the Federal Reserve, had still been in place in 1929, would the money stock have collapsed by over a third like it did?
And their answer.
Comparing the actual dynamics of the 1907 panic under that older system to the liquidity crisis that began in late 1930 under the early Fed, the sources strongly suggest the answer is probably no.
Really? The old system might have been better.
In preventing that specific kind of prolonged monetary collapse, perhaps, the pre-1914 system, they argue, would almost certainly not have seen a comparable decline in the money stock. The 1907 experience, while severe, suggests there might have been a sharper initial reaction, like a widespread temporary suspension of deposit convertibility, stopping runs in their tracks.
Which sounds bad, then.
But that mechanism, however disruptive in the short run, might have actually prevented the cumulative chain reaction of bank failures and the resulting grinding multi-year collapse of the money supply that occurred under the early Federal Reserve, which failed to act decisively as a lender of last resort early on. It really highlights how the specific structure of the system and the central bank's chosen response mechanisms made a critical difference.
Wow. So this deep dive through the sources, I mean, it's covered over 90 years.
Yeah.
From greenbacks and silver politics through the creation and early troubles of the Fed, right up to the post-war shift and policy focus. It really drives home how this often technical stuff, the interplay of money supply, banking structure, policy choices, it's just fundamental to understanding why we have periods of economic stability and periods of profound instability.
Absolutely. It shows us that these seemingly abstract concepts, bank balance sheets, reserve ratios, open market operations, They aren't just theoretical. They have direct, incredibly powerful consequences in the real world, shaping everything from the depth of economic downturns like the Great Depression to the pace of inflation.
So maybe a final thought for you, the listener. As you read today's headlines about interest rates or quantitative easing or bank reserves or debates about inflation and growth, take a moment to consider, how might the historical forces, and frankly the hard-won lessons we've explored today, the crucial role of those money ratios, the immense impact of shifts of public confidence in banks, or the profound consequences of a central bank's policy approach and intellectual framework, how might those forces still be shaping the economic landscape around you right now? It's a history that continues to resonate, giving us, I think, a much deeper perspective on the forces at play today.